very warm welcome to each one of you. Today's webinar is all about volatility, something that we have had in abundance over the last few trading sessions. So volatility, as we all know, feels a lot uncomfortable, feels unnerving at times, especially when you have big positions at hand, and it can take out the best of traders and take their positions by a big margin. So how can we use technical analysis, or how can we quantify this this beast called volatility and apply that in a way where scientifically we can manage our positions, we can manage our risk, and at the same time be level-headed in terms of managing our internal volatility. So it is said that for a boat to sink, the water has to get inside the boat. No matter how much is outside, doesn't matter. So unless and until the volatility doesn't get into your head, which is where the trading psychology comes into play. No matter what kind of volatility is there on the screen, if you are stable on the inside, that you can have a very different outcome as compared to otherwise. So let us quickly jump into today's presentation about decoding volatility. So I've started my screen sharing as about the 4 areas that we are going to discuss. To begin with, we'll try to understand volatility and what makes up volatility. Second is we'll try to identify the essentials of a good trade, the mechanics of a good trade, and then will be followed by the risk management or risk mitigation, how to manage your trade, and lastly the trading psychology part, where one can be in a state of mind where the market is no more a struggle. So coming to quantifying the volatility, which is the first slide. So as you can see in this graph, we've plotted the Nifty index over this period, and as you can see on the price chart, there are these bands which have been created at different stages. So what do these bands suggest? So as you can see, the thickness of these bands has varied across a period of time. So if you see somewhere towards the left half of the graph, the thickness of the band is quite less, and as we move forward, especially the current part, which is Nifty around the 20-minute mark, the band is very, very wide. So what this indicates is the volatility is increasing. So Nifty volatility, we've seen that the volatility has been high. So this can clearly be seen visually in terms of these bands, which can be created using a simple trading tool on trading view, and this can be quantified. Now, what is the technical landscape of a volatility? Let us take one step deeper and see how can we analyze this from a technical standpoint. Now, what are these measurable factors? What is this feeling of uncertainty? Can we quantify it? So basically the first step towards increasing volatility is the increased price range. So if you take any period, the high and the low, it could be a day, it could be an hour, it could be a week, or it could be any period that you choose. So the range of the price gets increased whenever there is a rise in volatility. And then this range is characterized by spikes. So you have these big spikes. The wicks of the candles are very big. You may see the lows and the highs being very extreme on either side, although the closing may not be towards the low or the high, but the wicks of the candles are very big. So the spikes are something which are characteristic of high volatility. Then you have a rapid rate of change. So rate of change is something that cannot be seen. If you see a daily chart, you may not be able to see the rate of change that happened in that day. But if you get into micro details, the speed at which the market moves, that is something that can be seen. If you are a screen reader, if you are sitting in front of the terminal, you can very well gauge it, and that is something like, for example, over the last few hours, for example, on one Monday session, it was one way up, then we had a cooling off happening yesterday, and today we have a bounce back. So over this period of time, markets have behaved at a different speed as compared to, let's say, a few weeks back, when the market was range bound, the speed at which the market moves was very slow. Just like a car drives at 50 kilometers per hour or 100 kilometers per hour. Similarly, we can see how much time does it take for Nifty to move 100 points, or how much time does it take for an index like Bank Nifty to move, say, 200 points or 300 points. This is something that can be quantified, and that is something which tells us how volatile the market is. And lastly, whenever this volatility is high, the trading volume is also on the higher side. Now, when does volatility hurt? Volatility hurts when a lot of people have their stop losses get triggered, or a lot of pending buy trades or sell trades get executed. This is a characteristic of high volatility, because what happens is whenever there is an increase in volatility, a lot of these pending orders get triggered, which is why the trading volume is also high. And once these pending orders get triggered, there are a lot of opportunistic traders as well who want to get into the market and try to make a quick buck. So what happens is there is an explosive increment in volumes that happen. These volumes could be hourly volumes, or these volumes could be daily volumes, depending on the magnitude of this volatile move that has happened. So given the case, all these things go up. So when there is when the volatility goes up, we see increase in price ranges, we see more spikes happening, we see the rate of change goes higher, there is a rapid rate of change, and the volumes are also on the higher side. So this is the technical landscape of the volatility. Now there are fundamental events also which translates into technical patterns. Now let us have a look at a few of them. So we all have read in the past that fundamentals fundamentals are something which do not act in the short term, they are more of a long term. But there are some fundamental events, like it could be a surprise earnings announcement, the numbers are more than expectation, that could trigger a gap up opening, and we may have a very large volume spike as well. Or it could be change of interest rates. The RBI comes and says that we are cutting rates by 50 bips, and all of a sudden all those stocks which were struggling to move will see big moves happening. There will be rising volumes as well. Or as we've seen just few days back, when there is geopolitical instability, which is a fundamental reason, this also causes an increased price range. So candles are wider. So as you can see, Friday and Monday candles, we saw both up and down moves happening in the Nifty. So these fundamentals tend to, or in other words, markets, 80% of times markets are moving based on what is happening as per liquidity, what is happening as per global sentiment. Or maybe in the remaining 10 to 20% of the times is where these shocks and surprises comes into play. So anything that is negative is a shocker, anything that is positive is a surprise. So these are the unknown factors which came into light and changed the trend of the market. Now this trend change could be a very ultra short term trend change for a few hours, few days, or it could be a structural change for a quarter or 6 months or for a year as well. So depending on the magnitude of the fundamental factor changing, we could have a big trend emerging, or at least in the short term, the volatility is definitely something that will go up. Now, how does technical analysis help in a volatile market? So technical analysis is something which excels at quantifying volatility and providing a framework. Now predicting the exact timing of volatility can be difficult, but if you see these technical factors happening, if you see these changes happening, you can very well be sure that volatility is something which can be on the rise. Now simply put, the first measure which everybody, like even if somebody doesn't use technical analysis, we have a look at India VIX. So India VIX is something which is a very good thermometer, or a sensor of what is happening on the market. So every time India VIX goes beyond 15-16% and higher, markets tend to be volatile. If it goes about 20-21, even more volatile. And we've seen in the past around 27, 28, 30% is where volatility is the highest, but at the same time the market bottoms out also at the same time. So there is also an oversold zone for the India VIX as well. So that is one indicator which is very good quantifiable tool. Now, how is India VIX calculated? It is the option traders' outlook on what is happening in the market. And option traders, especially option writers, are one of the smartest minds in the market, which are trying to make a buck out of something which is highly uncertain or volatile. And whenever these options turn expensive, the India VIX goes up. Whenever these options turn cheap, the India VIX goes down. So India VIX is one of those examples. Another example is the average 2 range, average ATR, as we all know. Then we have Bollinger Bands. These bands, every time they widen, the volatility is higher, and every time they narrow down, the volatility is lower. Now what happens is, when these happens, we can identify them with chart patterns and indicators, especially whenever the volatility is increasing, and we can react, or we can plan our strategy based on these opportunities that are available in the market. And we can take trades based on what is the market throwing at us. Now, let us look at step-by-step process of the mechanics of a good trade. So, good trade is comprised of multiple factors. So we have the price, we have the primary trend, we have the volume, we have the trend as well. So, very simply put, there is a saying in the market that Bhav Bhagwan hai. So Bhav Bhagwan means price is above everything. And if there is a senior god, if there is a god of gods, we call it Brahma Ji. So भाव भगवान है, वॉल्यूम ब्रह्मा जी है, यानी कि जो वॉल्यूम है वो प्राइस के भी ऊपर है, एंड उसके ऊपर जो है पूरा हमारा ब्रह्मांड है, यूनिवर्स है. सो यूनिवर्स इज बेसिकली द सेंटिमेंट दैट इज देयर. So just to give you an example, let's say a stock is quoting at 100 rupees a share. Now 100 rupees is the belief of those traders, whether they are ready to pay that price for the stock. If the price is moving from 100 to 105, which means the beliefs are getting more and more bullish. Now what happens is, when you have absolute conviction in your beliefs, your volumes will also be higher. So you will be taking big quantity in the trades, and what happens is, when you take bigger quantities in the trades, the volumes go up. So when you have price and volume both going in one direction, that is supposed to be an even stronger trade. And lastly, you have the sentiment, or rather what is happening in the equity scenario. So if the liquidity is positive, the global markets are positive, that adds up to the bullishness, and that adds up to the sentiment, and what that translates into is an even bigger move. So this is a very simplistic approach to what contributes a good trade. Now if you look at the price action analysis, it all goes into it, the support and the resistance, what are the candlestick patterns that are present at that point of time, and if there are gaps, if any. Then we have the primary trend. So primarily, for example, there could be a short-term correction that happened, but if the primary trend is still positive, more often than not, the primary trend will overlap the short-term trend, and markets will turn bullish at key support levels. So if we have an idea of what is happening on the primary trend, that goes into refining our trade into a much better trade, and our stop losses can be more meaningful as well. Now, how to identify trade in volatile conditions? So one method is using moving averages. So every time we have these long-term, short-term moving averages being breached or taken support at, these can be good reversal points. Or we could be having a look at trend lines or channel breakouts. These are the physical hard physics-based supports and resistances, or these lines which comprised of the technical set of the market. And then, as I said, volumes. So if the breakouts are happening on the back of strong volumes, these are the ones which are more high conviction. And then you have there could be potential exhaustion and accumulation phases as well. So these can very well be identified using the volume analysis. So what happens is if we have a preset list of stocks which fall into this category of a good trade, where we have all the factors lined up. Let's say we have top 5 long ideas, and let's say we have top 5 short ideas. So once we have this ready list of actionable ideas, even before the market opens, once the market opens, all you have to do is, if the volatility is extremely high and say markets are very close to the support, look for the trades which are the ones to be bought, and if the markets are very close to a resistance, look for the trades which are to be sold. This is how probably you can get into higher probability setups and make volatility your friend, and specifically improve your strike rate in these testing times. Now, how can we utilize volatility? So, there are these indicators that we discussed. So, these are the 4 indicators broadly which can be used. So, we have the average true range, which can be used to measure the support and resistance levels. You have the Bollinger Bands, which can identify overbought and oversold zones, and you can also identify the squeeze areas, that can lead to significant breakouts. Then we have the Keltner and Donchian channels, which can be used for the similar setup, and we could also use a combination of indicators where we are not only relying on one trade, one indicator, one setup, but combining 2 or 3 of them, and then trying to play out on the volatility side. So one strategy that we used in the tough period of the market, so we had a 6-month of period where Nifty was going lower and lower, and how did we identify the long trades? Was any stock which had an RSI of above 70 in a falling market. So let's say the Nifty RSI is trading around 50, the daily RSI, and the stock RSI is above 70. These are the stocks which will outperform the market no matter how low the Nifty goes. So as a strategy, we use this high RSI list of stocks as our long candidates. Every time they came close to their support levels, we would just buy them, and these stocks would invariably do well as compared to Nifty, and we had a fairly good strike rate in that kind of a period. So this is one of the examples where you could stick to these high RSI trades in a market which is essentially a bear market, and you can still be a bull in a bear market and still make money. Now coming to the trade management and risk management. So one thing that volatility calls for is a dynamic stop loss. So stop loss has to move along with the price. So if like ATR is something that you can keep as your trailing stop loss, every time this level improves, you can just keep on moving your stop losses higher or lower based on how the prices move, depending on whether you are long or short. Then you have scaling in and scaling out based on technical level. Every time these resistance or support levels have reached, look to book partial profits, look to average your positions based on these levels, and that can something that can refine your trading outcome in a very big way. And then position sizing is something which is very important. So as a team, we advise clients that every time Nifty RSI inches or climbs above 16-17%, do not write options in a significant way or in a riskier way, or take very little positions overnight if the India VIX is about 20%. So these are some of the position sizing based adjustments based on the volatility. And then you have the trading stop losses based on technical indicators. So as and when prices move favorably, you can very well move your stop losses based on what happens in your profitable trade. So this is all about the trade management and the risk mitigation. What happens is the emotional roller coaster, which is very difficult for most of us. Now the single most go-to strategy is have a predefined, technically driven trading plan. So if you have a predefined plan, the decision making is very minimum when the markets are on. So always have a very clear rule for entry, exit, and the risk management based on technical signals. Avoid chasing breakouts without confirmation. So unless and until you see volume based confirmations or you see a closing based confirmation, avoid chasing breakouts, especially if it is a volatile phase in the market. Always ignore the short term noise. So noise is something that can take you out of the trade. Unless and until your system is showing you, data is showing you a reason to act otherwise, do not be carried away by what is happening on social media, what is happening on the television, and just be focused on your trade. Thirdly, objectively reviewing trades based on execution. So if you can review your trades on a timely basis as to what went right, what went wrong, that is where the biggest learning will take place. And whatever that learning takes place, ensure that you write it down in a journal, so that this is something that can be a log of your the wins and losses that you've had, and essentially you can pinpoint your mistakes that have happened over a period of time and try to eliminate them in the coming time. So the key takeaways are basically master the price action and volume analysis. We learned about how to effectively utilize volatility specific technical indicators, and then implement these dynamic and technically sound risk management based on what is happening on the screen, what is happening on the indicator, and at the same time cultivate the discipline to stick to your trading plan. And lastly, continuously refine your trading strategy, refine your edge based on market behavior, because no two markets are different, no two periods are the same. Like for example, the way markets behaved in 2020 was very different as compared to the way markets behaved in 2008. So the principles of the market going up and down have remained the same, but the participants have changed. So what this participation change has done is the way markets have reacted has changed in a big way. So always refine your trading strategy based on what is happening at the current juncture. So we have a couple of examples where we had given these trades. So one was Max Financial Services. This long trade was given once the breakout was confirmed on the charts. However, we advised to keep a closing basis stop loss since the volatility in the market was high. So as you can see, there was a false breakdown that happened. Stock went below 1100, in fact went all the way down to 1080, and then sprung back right up, and then we saw a very big vertical up move and the stock stock going all the way up to 1300 rupees. So this is an example where the stock will try to trap the long traders, give a false breakout, and then trigger their stop losses and then finally go up. So whenever volatility is high, maintain a closing stop loss. Another example is in IEX. So there was a false breakout that happened in the first attempt, and then a breakdown, and then the breakdown eventually got turned into a second breakout, which ensured the stock went all the way up to 200 in no time. So these are some of the examples in which volatile market will be taken out of your trade only if your position sizing is small, only if you manage to keep a closing stop loss. Will these principles or these strategies will come into play and help you come out in a profitable way. So these are some of the ideas and strategies that we had we wanted to discuss with you. I hope I was able to add value to you and your time. We'll now open the floor for Q&A.
How to analyze the India VIX chart?
Yeah, so India VIX, the one thing about India VIX is it has behaved in a particular way for every 1 to 3 year period. As of now, what is a normal for India VIX is anything below 15-16 is a normal range for India VIX, where markets are not expecting much of a volatility. Anything above 15 and 16 is supposed to be an orange area. So above 15-16 all the way up to 18-19 is an orange area where caution is advised, and anything above 19-20 is a red area or where high caution is advised, and overnight positions are to be kept to a minimum. Unless and until these positions are hedged, we do not advise getting into leverage positions in a big way. So keep an eye on India VIX. If you want to keep it very simple, India VIX, every time it goes up and say Nifty is going up, India VIX is going up, it could be a reason that it could be a cautionary stance by the market. So you could very well trail your stop losses or reduce your position sizing as this happens. And on the flip side, when India VIX goes all the way high to 28-30%, these are the areas where markets have bottomed out and we've seen sharp reversals happening from there. So keep in mind on the extreme level as well. If India VIX goes all the way down to 10, 11, 12%, that these are the periods where not much has happened in the market and markets have broadly remained sideways or remained very, very stock selective. So I hope this answers your question. India VIX can be a very, very potent tool and something which is very easy to understand and apply in the market, especially on a live basis.
Should one trade or invest?
Yeah, so it all depends on what you're looking for. It's like asking that question is whether you should let's say your goal is to make 30% or let's say 25% return in a year. So trading is something which can help you achieve that 25% possibly in a quarter if the markets are good, if the trend is very good. So if you look at 12 months of a year, we have those periods or we have those months where the momentum is very high. So out of 12 months you have 3 or 4 months where the momentum is very, very good for trading. And trading is very easy in these periods. So these are the periods where trading can bring in that accelerated booster to your return, and the rest of the 9 months, 8 months, market could remain sideways, could remain broadly in a range where stock specific action is paramount. So Ideally, the best thing to do is have a blend of both of them. So out of 100 rupees that you are investing in the equity markets, have at least 30 rupees on the trading side, 70 rupees on the investing side, and then basically you can switch between the two based on the opportunity that comes in the market. Let's say the markets have become very easy in terms of the momentum is very good in the market. You could simply switch to more trading and less of investing. And once the market becomes sideways, you could get into relatively defensive stocks and probably change gears as and when required.
Why don't any advisors or experts focus on giving recommendation for buying at lower levels and only want everyone to chase momentum?
Yeah, so it's easier to chase momentum than to identify reversals. That is essentially goes by the saying that in the market there is this saying by the legendary investor Rakesh Jhunjhunwala. He said that it is always wise to be a bogie of the train, or don't be the engine of the train. It is advisable to just follow where the engine is going and not become the engine itself. So let the market take the first move and then you follow and make trend your friend, and that way you will have a more strike rate. That way your strike rate will be healthier, profitability will be higher. It may not be higher percentage wise, but the number of positive trades that you take will be higher. And the beauty about momentum based trading is it has got instant results. So once you take a trade, 2, 3, 4, 5 days, your trade will give you an outcome, positive or negative, whatever the case may be. But in terms of reversals, they can be very time testing. It could take a lot of time. Patience is tested, perseverance is tested. So not everybody's cup of tea. So if you're good at doing that, good luck for you. But most of the traders that we've come across, most of the fellow analysts that we've met and discussed, everybody has said the same thing, that it is easier to trade momentum than it is to trade reversals.
Whether one should invest in companies that have proved themselves and gone through the Agni Pariksha, and why are industry leaders offering moderate returns in future with lower volatility, or going for small and mid-cap stocks to identify that multi-bagger, which generally is elusive, and in the process see higher volatility and at times destruction of capital.
This is exactly where the money management principles come into play. So as a market, it will offer you everything, whether it is a moonshot stock where there could be a potential of the stock doubling or tripling over a period of time, or it could be a stock like HDFC Bank which may only end up going 10% in the entire year. So it all depends on your financial goals A, your risk-taking appetite B, and your money management. So what is money management here is, so ideally if I divide the 100 rupees, the best thing to do is say 20 to 30 rupees. Let's say a hard number, 30 rupees for trading, 70 rupees for investing. Now in that 70 rupees you can have two buckets, one or maybe three buckets, depending on your your goals and depending on which stage of your investing journey you are. So let's say we have two buckets to keep it simple. So the 70 rupees gets divided into, let's say, a growth bucket where we are looking to just beat inflation and make more than what FD is making. So let's say the FD returns are around 6%, 5.5%, 6%. I'm happy to make a 12% return. So this is where I'll be looking for growth oriented stocks. These could be, stocks which high dividend, stocks, which grow by say 7, 8, 10% in a year, have a 2 to 3% kind of a dividend yield. So net I end up making 12 to 14% in this basket. And then I have the second basket, which is, let's say, a dream basket. Here the high return, high risk stories can come into play. So out of the 70 rupees, 50 rupees can go into the growth area, 20 rupees can go into the dream basket. So these 20 rupees can be divided across small caps or mid caps where the promise of a big return is high. And the beauty of this market is nobody knows which stock will be the first one to go up. But if you have a good story, if you have the right set of chart setup into the same, if you take enough number of bets across a wide spectrum, there is a good chance that out of 10 or 8 or 10 bets that you take, some of them give a very good return, some of them give a very very average return, and some of them may be loss making as well. So net if you combine the entire basket, you may actually make the biggest return in that basket. So if you do this money management well, and some of the ideas do not work and fail as well, still as at a portfolio level, out of 100 rupees, you may only be risking 2 rupees in that one small cap idea, or 1 rupee in that small cap idea, and even if it doesn't work, it doesn't impact your portfolio returns by a big margin. So I hope you get the point. If you can do the money management well, these ideas can still be afforded, and some of them can really give you very good returns if the timing is right.
Should an investor be in a hurry to get higher and faster returns, or should he take a step back and try to get surer returns, even if one gets it slowly, without the excitement which normally the former has at the time of investing?
Yeah, so in investing, generally it is the boring stuff that creates wealth, but in trading, it is the hot stuff that creates the profits. So no, it is said that when it comes to trading, always look for the best momentum stocks, the stocks which are can give you the money, can give you the profit in the least amount of time. Whereas in investing, it is better to go with the fundamental stories which are time tested, which have a lot of strong moat to them. Even if it takes time, it's fine. So boring stuff probably will make you the wealth, and it's the hot stuff which can be riskier, but at the same time can be highly rewarding as well when the markets are good. So like I said earlier, it all depends on which segment or which part of the market, which cycle of the market are we in. If the cycle is good enough, probably that is the time to go more on trading and less on investing. And when the reverse happens, that is the best thing to do. Vice versa is the best thing to do. Thanks, Raj, and thanks to each one of you for participating. See you soon.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.